Something shifted in markets this week, and most investors completely missed it. For the past 2 years, the AI story has been about hardware, chips, data centers, power infrastructure. Nvidia was the face of the entire trade. But this week, the data told a different story. And it started with a company called Snowflake. Snowflake is a cloud-based data analytics platform. It posted what analysts call a beat and raise. That means earnings beat expectations, and future guidance was raised higher. That single earnings report breathed new life into an entire sector. Software stocks moved sharply. Oracle hit its highest price in 6 months. ServiceNow reached an 11-week high. Microsoft climbed to a 3-month high. And here is the number that actually matters. The iShares Expanded Tech-Software ETF, known as IGV, broke above its 200-day moving average for the first time in all of 2026. That is not a small moment. That is a technical signal analysts wait months to see. So let me break down exactly what this means, and more importantly, what it means for your money. The 200-day moving average is one of the most watched levels in all of investing. Think of it as a long-term baseline for where a stock or fund has been trading. When a stock falls below that level, it signals weakness. When it breaks above, it signals that something has genuinely changed. IGV breaking above that level tells us two things. First, money into software. Second, the market believes AI spending is moving into a new phase. Let me explain why that second point matters so much. The first phase of any transformational technology follows a predictable pattern. You lay the tracks before the trains can run. In this AI cycle, the infrastructure phase meant chips, servers, and data centers. Nvidia, AMD, and the data center build-out dominated the trade, and it was a historic run. The Nasdaq 100 is up more than 21% over just the past 3 months. That is an extraordinary number. But here is what that data also reveals. Markets do not stay in one gear forever. Once the infrastructure is in place, the value starts flowing somewhere else. It flows into the companies actually using that infrastructure, the businesses deploying AI tools to generate real revenue. That is the software layer. And this week's breakout is telling us the market is beginning to price in that shift. Now hold that thought, because there is an important detail here that gets overlooked in most market coverage. This is not about any single stock. This is about where the earnings growth is expected to come from next. Corporate earnings in the software sector are being driven by AI adoption. Companies are paying for AI tools that improve productivity. They are paying for data analytics platforms like Snowflake. They are paying for cloud services from Microsoft and Oracle. The spending that Anthropic, OpenAI, and others are generating is flowing into revenue for software businesses. And this week, the market started rewarding that. If you are finding this useful, consider subscribing for more practical financial insights. Now let me be direct about something. This shift does not mean you should sell every chip stock you own. It does not mean hardware is done. The AI infrastructure build-out is enormous and ongoing. Anthropic was valued at nearly $1 trillion in a pre-IPO round just this week. Alphabet announced plans to raise $80 billion to fund AI development. These numbers confirm the infrastructure spending is not slowing down, but they also confirm something else. The companies building on top of that infrastructure are becoming increasingly valuable, and that is where the software rotation comes in. Think about it this way. Imagine the gold rush of the 1800s. The people who sold the picks and shovels made reliable money early on, but as the mines got built out, the money started flowing to the companies processing and selling the gold. We may be entering the processing phase of the AI gold rush, and most everyday investors are still holding the shovels. So what does this mean practically? If your portfolio is heavily concentrated in pure semiconductor plays, it is worth asking yourself a question. Have you looked at how much exposure you have to the software layer? That does not mean panic selling or chasing momentum. Chasing last week's winners is one of the most common and costly mistakes retail investors make. But reviewing your allocation with this shift in mind is genuinely worth doing. ETFs like IGV give you diversified exposure across the software sector without picking individual stocks. You get Snowflake, Oracle, Microsoft, ServiceNow, and others in a single position. That kind of broad exposure is how everyday investors can participate in sector rotations without taking concentrated single stock risk. And this matters even more at current market levels. The S&P 500 just closed at 7,580, up 10.7% year to date. The Nasdaq is up 16%. These are not cheap markets. When markets are expensive, quality of earnings matters more than ever. Software companies with recurring revenue and growing AI contracts tend to hold up better when sentiment shifts. Because their earnings are predictable. Hardware companies are more cyclical. Their revenue depends on massive capital spending cycles, which can slow quickly if corporate confidence wavers. Now here is something else worth paying attention to. Charles Schwab analysts noted this week that 9 of 11 S&P sectors actually fell on Friday, even while the index hit new highs. That tells you something important about how narrow this rally has been. A small group of technology stocks is doing most of the heavy lifting. When breadth is this narrow, it is a signal worth respecting. It does not mean a crash is coming. It means the market is selective right now, and selective marketers who understand where the real growth is concentrated. The software breakout this week is one of the clearest signals we have had in months. It tells us institutional money is moving. It tells us the AI trade is maturing. And it tells us the next chapter of this bull market may be written by companies you have been underweighting. Snowflake up sharply on earnings, Oracle at a 6-month high, Microsoft at a 3-month high, IGV breaking out for the first time in all of 2026. These data points are not random, they are connected, and understanding the connection is what separates reactive investors from informed ones. The market is always rotating. The people who track where the rotation is going tend to make better long-term decisions. That is what the numbers are showing right now. What you do with that information is up to you.